thinking about developing a schedule for the evening, I wanted to do really something special. I also wanted to show off our wonderful school and the UR spirit to a few people who may not have seen it or have experienced it. And we are extremely fortunate today to be joined by some very close friends of mine who each in their own right is incredibly successful. This is a collection of some of the leading people on Wall Street. And yes, they're young looking, all Grecian formula except Alan or Murph. And I just really want to introduce you. 2 managed public equities, 4 run large private equity firms, and 1 manages our university's endowment. The first person all the way to the far right is John Barker. John Barker is one of the leading public equity managers in the nation. He manages over $15 billion, which he has discretion on. He sits and talks to some of the leading corporations in America every day and will give us a unique insight into what large companies are doing these days. Next to John is Alan Breed. Alan runs Edgewood Management, which is a very, very successful public equity investor. He's also a member of the university's trustees, and he has 2 children that go here. Next is really a titan, Joe Landy. He's the co-president of one of the largest private equity firms in the world with over $35 billion under management, and he's so young to have such a big job. I'm still amazed. Next to him is a very good friend of mine, Doug Londell. Doug is a general partner and one of the founders of a very successful private equity firm that manages both a hedge fund and a private equity firm. Next to Doug is my very good friend, Tom Murphy. Tom was a partner at Goldman Sachs when it went public, so he gives all of us loans. After Goldman Sachs, he decided to, with a couple of colleagues, to found a firm that manages over $4 billion in private equity today, investing in a host of companies across different industries and across different geographies. Next to Tom is Srini Polavarti. Srini Polavarti manages the University of Richmond's endowment, of which the University of Richmond manages $1.7 billion of their own capital and $1 billion of outside capital. Over the past 3 and 5 years, the University of Richmond, yes, the University of Richmond has had the #1 return of all endowments over $1 billion, and that's credit to Srini. And finally, someone I like to refer to as Mr. Wonderful, boy wonder himself, Ted Virtue. Ted was the president of Bankers Trust, actually did a lot of business with Chuck when he was there, and then went out and founded Mid-Ocean Partners, which is somewhat of a consumer-oriented private equity fund and has many of the leading brands in the nation that he's purchased. This is truly a terrific panel. And we have a number of questions from students, but before we do that, what I really want to do is I want to talk about what businesses are seeing from the ground. And Joe, very few firms, that's right, Joe, very few firms are as wealthy and as diversified from you, as Warburg Pincus. And what I'd like to know is, where are the pockets of strength coming from today? You invest across the globe.
Well, that was pretty much a softball, Paulie. I was worried about what might come from the podium over there, which I always am when Paulie has the mic. It's important to actually put private equity into context. And the name of this panel is a word from Wall Street. Frankly, any of our firms can exist anywhere in the world. We are the investors. We're not the ones who caused the crisis, which we could probably point a few fingers there. But what we do is we invest money. And at Warburg, this isn't a commercial, but our strategy is to invest it around the globe. And it's invested in different geographies, from all the emerging economies to emerged economies in the world, as well as the U.S., and across different industries. Everything ranging from energy to quick service restaurants to financial services and to TMT. As one talks about where the pockets of strength are coming from, I mean, it's clear the emerging and emerged economies of the world represents just one of the great investment opportunities that I have seen in the 27 years I've been in that business. How's that for you, Paul? And when economies are growing at 9 to 12 or 13%, I don't even think anyone knows how fast China is growing. You just need to ride waves across a number of industry sectors, and if you can put up with some of the additional risks in those countries, which may include a lot of the qualified management teams, there is a lot of different ways to make money. Bringing it back home, I think probably the other great place to make money is right here in this country. And when one sees entrepreneurialism and management teams, teams that actually emanate from great business schools like Robbins, this country has a lot of unique assets. And we actually believe we can make monies in different sectors wherever we find talented management teams. But just to bring it down to sectors, whether it's digital media, it's a huge just growth in this country right now, and we're seeing a lot of opportunities there. We see it in energy, both traditional energy as well as alternative energy investments continues to exceed the various indices in terms of their rates of return. And we're also seeing it in the various technology sectors, which will, for the foreseeable future, just remain a great place to put money in this country.
Ted, you own a number of consumer product companies, all of which I enjoy getting free goods from. And what are your companies telling you? Are you seeing growth come back? Or are you seeing the consumer come back?
You told me you're going to be the final four question. First off, congratulations, Paul. I'm thrilled to be here in your honor, and you and Anne-Marie do for the school is fantastic, and I applaud you. I also applaud the administration here for 26 or 27 years ago, making sure you graduated. Which I'm sure was no easy task, but having the wisdom to know that this might be possible. So anyway, thrilled to be here. You know, we're seeing a pretty good rebound. I mean, you know, of the last, after the 08 and 09 issues that, you know, cut discretionary spending for most Americans, we've seen a good rebound. A lot of that is really a government-sponsored, spending program that's pumped liquidity back in the system. I think we're going to have at some point we're going to pay the price for that. But for the time being, while QE2 is going on, we think there's a big boom both in consumer spending and commodities generally, and equity prices are being well supported by the government. I think there's a day of reckoning there, but we're trying to take advantage of that across our businesses and making sure we innovate and bring out new products while there's a real liquidity boom in the marketplace. How about the pricing, the raw commodity price increases that are coming down the line? Can you pass them on to your consumer? I'd say, it depends on the business. I mean, most of our businesses, we have leading product brands where we do have some pricing flexibility over the marketplace, but it's staggering. I mean, you've seen what happens in food commodity prices over the last 6 months. I mean, I was saying, lettuce is up, 100% in the last 4 or 5 months. Small ingredient we own a company called Sbarro's. It has a big impact on our end customer, and that's something that's hard to push on. So I think that's a real risk with this inflationary pressure that the government's creating. So the message here, if you like lettuce, don't go to Sbarro's. Alan, what are the larger companies telling you about business environment?
I would say that for the most part, everyone is focused on the emerging markets. All the big companies are in the emerging markets, and if you assume that the S&P can grow for a round number, call it 10%, well over half of that is going to be generated by the divisions that are outside the U.S., whether it's China, India, Brazil, those types of things. And more importantly, the investment opportunities that large companies are seeing are overseas. And until we, as a country, get our regulatory policies in shape and our tax policies in shape, I think you're going to continue to see that type of capital and investment opportunities flowing away from the U.S. And that's sort of, as a general rule, what we're seeing.
Is that all driven by the government doing a bad job, or is that something that's driven by just opportunity? If you're like a Yum Brands, you're going, You got a lot of Taco Bells and Pizza Huts in the United States. You can't build another 1,000 of them, but you can't build them in China.
Yeah, I mean, the population centers clearly are overseas. The governments, if you look at Steve Wynn as an example, who Ted knows, has moved his headquarters out of the United States. There are certainly, that we have a tax policy that's not nearly as friendly as other countries around the world, and we've got to come to grips with that to become more competitive, and hopefully that will get addressed. But for now, if you take a normal big corporation, the IRRs that they're seeing are most of them, if you're going to be above 15%, are all offshore. And I would say the centers of that are Brazil, China, and India.
On inflation, okay, this is the question that we are asked almost every time we are on a panel or every time I speak. You have to look at inflation in three different ways. If the inflation is between 0 to 3%, it's not a big deal at all. Nothing happens. I think the businesses can pass through or they can absorb it. If the inflation is 3 to 5%, then we have certain kind of effect on various sectors. But if it is over 5%, then we have a serious problem. So what is the probability that it is over 5%? Very, very little. And could it be between 3 and 5%? Sure. But I think our system can work through that. Most likely, the highest probability that we assign, at least I assign, is somewhere between 0 to 3%. We are not even close to 3%, I think. You have to understand that you have to remove, calculating inflation has become a very complicated exercise. If you include oil and gas, if you include food, if you remove the top line, the headline, so it gets complicated. But otherwise, we think that as long as we are between 0 to 3%, we should be fine.
Do you agree with that, John?
To a certain degree. First, I'd like to spend my first 30 seconds once again applauding you tonight. I would like to say, and I kind of crafted this as I was coming here today, there's not too many people I know in the world that can be trusted with success as much as you can, and I applaud you for what you do. Inflation, when I think about it, what worries me, and I think what should get people concerned, is not really, although we do have all sorts of commodity inflation these days, I think the long-term killer for the markets would be wage inflation. And to the point we are today, I could take it back 10 or 15 years, but if you think about what drove the markets from the early 90s through the 2000s, it was the sense that innovation and technology and disintermediation, and obviously the biggest catalyst of that, the internet, would continue to push inflation lower and lower and lower. I was more concerned through the 90s and 2000s about deflation than ever was about inflation. Today we have a coiled spring. There is way too much money that's at loose in the marketplace. I don't know that I could target where it might end up. But I do have confidence in the U.S. economy to rebalance at some point, and I do think that when we have to, we will pull some of those funds from the system. In the meantime, we do have an issue to deal with, and we hope that it's under control. And I would say particularly be careful about wage inflation, because that's the killer.
So we have a situation right now where there's too much money in the economy. There might be a spring effect. Deals in the private equity business are much overpriced. So Tom and Doug, where are you guys finding opportunities today amongst this competition, not only from other private equity firms, but from strategic acquirers?
You want me to go first?
Yeah.
So thank you for having me. I'll spend just 2 seconds saying that. I'll spend more later. Unlike my friend Joe, we are domestically focused, so we don't have the pleasure of actually going to a lot of the growth in the emerging markets. And we're a fairly lean firm, so my constraint on having an emerging effort is pulling my son off his baseball team, which would not be allowed to happen to move over there. Our focus is, how do you find growth in the U.S. economy? And then we'll talk about inflation, because I think I probably am more concerned about the coiled spring from an inflation standpoint. From a growth standpoint, what we look at is, how do we find real growth sectors but not take the risk that often comes along with the growth sectors? So digital media was something that was mentioned. We think that's a fascinating area, but investing in a company that's providing the hardware or potentially some technology for digital media is very tricky to navigate. And so we've thought about, how can we invest and benefit from the space without taking that bet? So we've focused a lot on the infrastructure around digital media, for example, where you think about, for example, cell towers. Cell towers, when you think about broadband and what's happening, we've got a view that ultimately there will never be enough bandwidth, because as bandwidth is created, more people put out more applications. All of a sudden it takes 2 seconds instead of 20 seconds to download ESPN, and so more people use it, and so there will continually be a chase for bandwidth. And so we want to invest in things like infrastructure that support that bandwidth and should continue to grow over time. Another example of that infrastructure play is digital couponing. So everybody can walk around right now on their iPhone and you can buy things. You saw the joint venture between a couple of the phone companies being able to pay for things. So what we're doing is we've invested in a company where we're hooking up to the POS and just being the infrastructure that allows whoever's the winner in that war of mobile couponing and telephony and digital wallet to be able to go through our system. So that's, from a growth standpoint, it's trying to find those pockets of growth without necessarily taking the risk. From an inflation standpoint, we're ultimately measured on real returns, and I am concerned about inflation. And so we're trying to find pockets in the economy and companies that are either isolated from inflation or might even benefit from inflation. So isolated from inflation, I think about distribution. If you've got a distribution company where you're not necessarily at the whims of the inputs and the output pricing, you're providing a service, but for the wages that you have to worry about, you actually can continue to have a nice business and not worry about what the pricing does on the input and the output. The other thing we've done is our firm traditionally hasn't invested in a lot of asset-heavy firms, but we're more and more thinking about investing in businesses that have assets, because if you invest in whether it's manufacturing facility or distribution that requires a lot of assets, that's a fixed cost, and so ultimately as the input price gets passed on, you're benefiting just from the fact that you've fixed on those assets.
I think those are all great points. I'll be brief. That's a micro set of observations. I give you a slightly different view. Look, life's always tough. There's always competition, right? 2 million years ago, you woke up and a dinosaur might eat you, right? I mean, life's tough. And I think today, Buffett always says it, we live in a country where a lot of good things can happen, and the world tends to beat its path towards our door. So I generally feel good about our opportunity. Do I think inflation's an issue? Yeah, I do. Do I think it's going to impact the recovery? Certainly if food and energy prices keep going up, sure. I think that'll happen. But I also think prices have been down, people have been beaten down. The half-life of people's ability to be pessimistic is pretty short. We're a country that wants to get after it, wants to move forward, and I think things improve. What we've been buying for the past several years, we tend to focus on distress, troubled, out of favor, bankruptcies, things like that. We go to that value. In that environment, it was easy for us to invest a couple $1 billion over the last few years. Looking forward, I think we are adding small businesses to consolidate expenses out of businesses. We are trying to take small businesses and get them exposure to the growing markets that Joe and the other guys have talked about. I think we are borrowing a lot of money at many of these companies at very, very low fixed rates because rates are very low right now. We think inflation will be our friend as we pay that money back in nominal dollars at much lower costs. But we still actually feel pretty optimistic. The strategic people have not come into the market. When they come into the market, I'm going to have to give them everything I own and put a ribbon on it and thank them for buying it. Because every now and then you have to sit back and wait. We've had 2 businesses, 2 funds we've raised, and in both of them we've gone 15, 16 months without investing anything. I think we may be coming into a period where we have a slowdown in what we buy, but I still like the U.S. economy. I still like the ability of us to compete on a global basis. In the long run, I'm a big buyer of what we sell, and I think it's a little bit of the message you're delivering to your students here, is that what you learn here allows you to compete. Kaylin, when you go to your job, you'll find it. The ability of our people to compete on a global basis is really quite compelling because we free people up to do that. So I'm not that pessimistic about it.
Write that down, Caitlin. That is Mr. Murphy told me.
And he's
We have another question from Mike Collins, who's a student here, about an interesting part of the internet. Yes, Mike. Mike, where's your tie? Didn't go to Q camp.
It's pretty tough in class too. It's a great class. But I have a question about the tech industry. All this talk about valuation IPOs of companies like Facebook and Twitter, as well as a lot of funds throwing money at younger companies trying to find the next Groupon or Zynga over the verge of another tech bubble, or as Mr. Laney said, it's a strong pocket where someone would be looking to put money to work.
Serini and John, you're...
Yeah, I'm far too inexperienced in the private world to understand the valuations in the private marketplace, but as they come to the public, I have to deal with them. And I'll be honest with you, I was the first person to make the mistake not to buy Google when it came public. I learned from that mistake and bought it a few months later. But just an example of the kinds of things that can happen in the market, and I'm not going to opine on whether or not the valuation for Facebook is right, but I can tell you this. We own a company called Sina, which is, it's a Chinese internet company known as a portal, but really has a very interesting sub-business, which is a Twitter-like business, a microblog, which, now get this, in January of 2010 had 1 million subscribers. By April they had 30, by August they had 75, and by December they had 110 million subscribers. Those kind of growth rates, whether it's China or the United States, they don't happen very often. And when you see the momentum that can flow behind a business like that, and then watch the ability to monetize that asset, this particular company is very interesting. They've decided not to monetize it until they completely wrap all those 110 or 150 million consumers into the fold, and then hit them with everything that they need to make money on it, whether it be advertising or some marketing and promotion that will actually develop the business. We're always going to find companies like that, and hopefully the marketplace will be willing to capitalize them, to bring them to the market, let the market sort out what the valuations are. We do get into trouble from time to time with valuations, and if you think about what happened in 2000, it cost us a couple of years worth of growth as we dug out from underneath that. But along the way, a lot of wealth is made and a lot of wealth is distributed. And I'll leave it to my friends here on the panel on the private side to determine whether or not those valuations are absurd today. I'd say you have to think about what they can add to the economy, what the growth can be that comes from that. And I'm expecting Sina's growth to be extraordinary over the next couple of years.
Now, Serini, the University of Richmond's endowment, owns a pretty significant stake in Facebook.
Yeah, our own view is that we are actually going through a transformational phase in our society. And just to step back, I will focus on technology. I'll come to technology. But if you think of the United States over the last 50, 60, 70 years, we are primarily, we are an economic power. And number two, we are a military power. And number three, which is the most important, we are an institutional power. We have the best universities, we have the National Institute of Health, we are the front runners in medical research or any type of research. And so the fourth, which is not talked about, we are the moral leaders of the global society. And so we look for change, and we think that technology, as we see it, is a manifestation of the change that will result in a lot of opportunities for people like us. So that is the overarching view that we have, that technology is going to be a very, very significant source of change. I'll give you an example. People focus on Facebook, but before Facebook, we have been living with Amazon.com now for around 16 or 17 years. I used to work at a place called Howard Hughes Medical Institute, and we had Jeff Bezos come to us around 94 or 95 and asked for $20 million. And our chief investment officer just threw him out of the room because we didn't know. Nobody could understand what the power of Amazon.com was going to be. Even until 3 years ago, nobody knew what Amazon.com was going to do. They thought it was going to be a retail outlet to buy electronics and clothes. But today, we just met with a venture capital firm yesterday or day before in our office. Now, Amazon.com is not only in retail, but they're also going to be a place where you can actually put your servers, start your company. It's a one-stop shop. And so if you look at Amazon's trajectory over the next 10 years, nobody can predict where it is going to go. Right? That is just one company. And so if you multiply that, and if you multiply the fact that the entire world can now adapt those technologies almost instantly, right? We travel extensively, and so as do all these gentlemen here, and you don't see laptops anymore in airports. Everybody is going to have a tablet. Everybody is going to have an iPad, iPad 2. And so it is really transformational. So I think that if you look at where we are going in terms of technology, I would be I'll be long technology. I'll be a very, very bullish on where we think we can go with what we are seeing today.
With Japan, and we're going to try to cut this a little bit because we started late. Nuclear disaster in Japan, a country that is obviously going through great stress. How does the individual investor play the rebound in Japan? Alan?
Well, obviously it's a terrible tragedy. I think to quote Murph's friend Warren Buffett, he had a very interesting comment. He said that 10,000 people will die from the tsunami, 300 people will die from the nuclear fallout. We're going to rebuild every house on the beach, and we won't build a nuclear reactor for the next 15 years. And so there are significant ways in country to play that. But I would say this could be just what the Japanese really needed. They've got a society that's getting much older. They've got enormous savings. They've got huge government deficits. And you've got to somehow unlock the spending over there to get things moving. And it's the old broken window analogy. If you break the window, do you have to go replace it? Is that good or bad? Because you originally had a window that worked, but we've got to go fix the window. If you look back at the Japanese after World War II, it was clearly a lot worse than it is today, and now they're the third largest economy in the world. Prices went on sale after that happened, and I would have great confidence in that. Picking individual stocks is outside of what I would do, but for the most part, I think you could buy benchmarks.
So Alan wants you to invest in his mutual fund. John, you have any thoughts?
You know, we have a lot of thoughts, and we did go to work looking at individual securities and buying some stuff afterwards. And I hate to say that because it wasn't a face for tragedy. So I said a few prayers first, and then went to work. But we focused on energy in particular. And if you think about how much energy is being sucked up by the emerging markets, particularly in the Far East, we knew that there had to be an imbalance immediately as an outgrowth of this. And when you consider how important nuclear had become, the alternatives to it, at least in a short-term basis, even though we're going to count on nuclear going forward, the risk was to the upside in other energies like natural gas, like solar, like liquefied natural gas, three markets that have been suspect of late. But when you think about how much capacity is going to be taken out because of this issue, and it's going to be around the globe. I mean, you know, the talk in Germany is that 15 gigawatts of energy could potentially be decommissioned as a result of this, depending on which political party is in place. That means that there's going to be a tremendous demand for some of these other sources of energy. So we went and bought natural gas as much as we could in safe geopolitical locations. Companies like Canadian Natural Resources in Canada, Range Resources in the United States. We went after some liquefied natural gas plays as well. I think Japan imports 70 million tons of LNG every year. That number is going higher, and it's going to stress the liquefaction capabilities that they have to bring LNG into the country. So we bought British Gas, which is a company that has, I think, 75% of its production is from LNG. That will all get swept to the Japan region, and the demand will go through the roof there. And I guess solar as a third way, absolutely a part of the future. Alan knows a lot about First Solar. We talked about it coming down here today. It's a company we bought a while back and added to it on this disaster because solar has to become a more important play here, no matter how you turn this. Long term for nuclear, I don't think it's going away, but we've got a 3 to 5 year period here where you're not going to get anything done. And in the meantime, these other clean, burning, important, economically or ecologically sensitive forms of energy will be very strong.
Hey, Joe, what is that? You have lots of natural resources at Warburg. It's a big part of your business. Are you selling into this strength, or are you continuing to buy from a private perspective?
Actually, the strength is, I find a little bit confusing. I mean, the first thing that I would have wanted to do as a retail investor after this tragedy is to go out and buy oil, buy alternatives, because my guess was those were going to go through the roof. What happened? Oil went down. And I think that the retail investor, which was your last question, has to be very, very careful if it's looking to make short-term kinds of gains off of tragedies like this, because there are forces at work in the financial markets that no retail investors can control, whether with esoteric financial instruments out there that are being closed and things that are happening. I mean, Ted can probably speak to some of this better than I. When I think longer term, I do think alternative energies actually become more significant, but those each march to their own kinds of economics. And I think you need to be careful there too. And we could go very deep into those, but you need to be careful in each particular one because they all have their set of unique characteristics. There are a couple of other trends that I think will have much more of a medium-term impact, and I don't think the world's actually really felt it quite yet. We're starting to see it in the auto parts industry, which the Japanese are huge providers of, and they're actually cutting back on supplies, and we're seeing prices starting to rise there. You're going to see that coming through in Japanese autos very, very shortly. And one that I haven't seen yet, and no one would actually really think of this, is Japan continues to be one of the leading semiconductor and substrate producer that goes into semiconductors. There was human capital that was devastated through all this. There was also capital that's put to work contributing to these supplies throughout the world. You're going to see that in consumer electronics, and you're going to see that in a variety of things. I mean, the amount of electronics that are used in everything we do these days is staggering. So those are kinds of trends that I think will continue to play themselves out as Japan continues to divert resources to rebuild everything that they just lost.
Okay, this is ultimately a school, and Caitlin has a job, but maybe some of her classmates do not. What would you recommend to your son or daughter about career choices? And Ted, you have sons and daughters that are at that age, as do you, Murph, and you've got very interesting perspectives on it. Where do you go today?
I think you want to be in growth, just like we're investing in. So you want to be in areas where there's opportunity to grow. If you work in a dying industry, you can be a great leader in a dying industry, and you will, as Warren Buffett has said a million times, great leaders in bad companies become bad leaders. So I think you want to be around that. I'm a big proponent of liberal arts educations. I'm on the board of one.
So on the board of Middlebury.
And so I love the breadth of an education you can get at a place like Richmond. What I would encourage people to do, because oftentimes undergraduates get so focused on the environment in the school and lose perspective on the job market's moving so rapidly towards specialization much sooner than a liberal arts major would typically want to. Getting internships, should be one of the priorities of the school. I'm leading a charge at my school to do that. Trying to get alumni like Paul involved early to try and bring in kids can be just transformative to the ability. When you talk about getting 300 or 400 internships a year, with the number of alumni at Richmond, it can absolutely change people's perspectives. It gives them the ability to talk about business or talk about whether they're going to be in education or whatever field they want to go into. I think that's a big push that Richmond should have. I'm sure they have, and can change the way the student body matriculates into the workforce.
Murph?
Yeah, I think all the things Ted says are accurate. I come to things a little differently. When I was at Goldman, for a couple of years, I ran recruiting in the investment banking division. I used to tell all the kids that came to see me, I want you to do three things. I want you to focus on going to work for smart people, because if you work for smart people, you'll learn faster. Go to a place where you can tell they're set up to teach you. A lot of places you go to work, the person you're working for isn't trying to promote you. They're trying to keep you down and push themselves up. But there are institutions out there where you work for them, and they're really trying to advance themselves by pulling you up. And you can figure out very quickly where those places are, and you want to work for people that are honest, because when you start your career, you don't really know any better. You're walking across the square here, you cut a corner, all you do is leave footprints in grass. You go through that in life, you damage your reputation. If you work for people who are not honest, are not smart, are not motivated to take care of you, you ultimately damage your career. So I think when you start, it's important to get a stable, broad base. Go to work for people and institutions that do that, and have a little patience. It's hard when you're 22. It's hard when you're 52. But as you get older, you get in a hurry because you're aware that the time's running out. And when you're starting your career, you're in a hurry because you're just in a hurry to do everything. And I think having a little patience and focusing on those things, you tend to end up making better career choices. You work with better people, have a little more longevity to your career, and ultimately all the decisions I've made along those lines, either to be with people who I think are smart and honest and capable, work at firms that are great firms. You're going to work at a really wonderful firm with a wonderful reputation, and that's a great thing. Your career's on its way. You've taken the time to be at this school and invest in your career. Watch that'll all work out very well. I think being in we are all so lucky to be in this country. Srini comes from the other side of the world, and he comes here to make his life. And the world's going to keep doing that. This is a great place, and you got great training from a school like this. And I think as you start your career, those are the ways I would look at it.
Well, and Paul, one thing to add to that, and this is a little trite, but you got to do something that you love doing.
Absolutely.
I mean, Paul loves doing everything he does, but the hours add up, and when you get as old as
As
people who are-
Murphys?
Yeah, I was thinking who I was going to pick on the panel. I decided not to pick one. But it's, the hours add up, and you've got to love what you're doing, and you got to feel good about it when you go home, because it is a grind if you don't like what you're doing.
Alan, where would you go today?
I'm going to drill down a little bit deeper than that, because while I think that's all very good, you've got a lot of people here who are going to get out of school in the next couple of years. And when we all got out of school, we applied to bank training programs, and whether it was Goldman Sachs or Bankers Trust or whatever, and that's where a number of us went. All of those institutions have changed, and will never go back to what they used to be. Goldman's public, and it's a big bank, and Bankers have been absorbed 3 different times. So what is really, what's happening in the Wall Street world that I see? And there are 2 people that are going to make real money going forward, 2 types of people. Either you're going to be the kind that raises money, which, as everyone on this panel will tell you, is in the private equity business, is what keeps it lubricates the engine, and is where many of them spend a lot of their time. Or you're going to be someone who can put the money to work and make money at it. Everyone in the middle is getting squeezed, whether that's the institutional salesman or the institutional trader or all these other jobs that you used to hear about that so-and-so had. All of those numbers are going down. And what has really risen is, at first it was for the private individual side of the business. You're seeing a lot of people go to work in the high net worth department of JP Morgan or Wells Fargo or what have you. There is a cottage industry growing up now called registered investment advisors. And in the last 8 years, the amount of money that's gone into that field has tripled to about $1.7 billion. And there is a tremendous need for talented people there. And I think part of the programs that Paul put into this school is very helpful. And what Sereni's doing is incredibly helpful. We are all one step removed from the client, more than we were 12 years ago. We now have consultants, registered investment advisors, pension people who get between us. It's not the same business that we all joined. We are but an arrow in the quiver of what Sereni's doing. And so in Sereni's case, you go direct, but in most of the cases that we deal with, there's someone between us. And that registered investment advisor role is going to continue to grow because it's a best in breed, it's a best in class. And so I would encourage all of you to go to these RIAs in your neighborhood that are growing. They're constantly looking for people, and I think you'll find that that's a very fertile ground. The asset allocation model is going to become more and more important. As all of us will tell you, John and I have been in a business where U.S. equities have been losing a spot in the allocation for quite some time. If you went to JP Morgan private bank with $10 million 5 years ago or 10 years ago, you had 50% U.S. stocks, 35% U.S. bonds, and some cash. Today, it's 5% in U.S. stocks, and the rest is alternatives. And as a businessman, that's hard to fight that type of flow. And I would encourage all of you students to look at that, to try to go up a level, get closer to the client, and try to learn from the way Spider Management has evolved and the amount of capital and the way that they put capital out, because it is the future. You've got a great building to teach you how to do that. You've got great professors to teach you how to do that. And I know Paul is going to be pushing at it, as am I, to continue to develop programs in that area, because it is absolutely the way capital is going to be run for the next 10 years. And so I would highlight that.
Ed, that is the word from Wall Street. Thank you very much.